Is your city heading for a housing crash here in 2021? That's the question that we're going to cover in today's video, and I'm going to arm you guys, you potential home buyers and real estate investors out there. I'm going to arm you with the data that you need to figure out whether your city is going to face stiff, dramatic price declines over the next year or two, or whether your city is still a safe and secure place to invest. Now, let me tell you guys, using data like this has never been more important because more broadly, the U.S. housing market's in a big bubble. And I think we're going to see price declines across America over the next 2 years more broadly. However, those price declines are not going to impact all areas of the country equally. Simply put, some cities are in deep trouble, in my opinion. Some cities are going to face 20, 30, 40% home price declines going forward. Other cities, I think, are still safe, secure places to invest where if you buy today, you're still going to experience continued appreciation. Now, how do you pick one city from the other? Well, you got to use data. And in this video, I'm going to share with you guys 3 real-time data points that I am using to help inform my clients who I coach on the best places to buy real estate here in 2021. By the end of this video, I'm going to reveal to you guys some cities that you need to definitely avoid from a real estate perspective right now and some cities that you should target from a real estate perspective. Now, let me warn you, this video is pretty data intensive. I want you guys to bring your attention spans here. But if you stick with me throughout the 20-minute video, I promise by the end, you're going to learn some really key insights about real estate more broadly and the direction of your housing market in particular. So without further ado, let's get into it, guys. And so let's start by looking at that first data point that you should be tracking to figure out whether your city is a safe place to buy real estate in 2021. And this data point is represented on the map here, where we're looking at every metro area across the U.S. And we can see, obviously, the U.S. is a really big place. Lots of different metros, lots of different places to buy real estate. And the color coding on this map is related to that first data point, which I call appreciation acceleration. Appreciation acceleration. That is measuring how much home price growth has gone up in the last year compared to the previous year. And let's start with an example so I can make the point more clear. If you could take a look at Austin, Texas, this is actually the city in the metro that I live in. From 2019 to 2020, basically from the summer of 2019 to the summer of 2020, home prices in Austin went up by 4.9% year over year. Then from the summer of 2020 to the summer of 2021, home prices in Austin went up by a massive 37%. So home price appreciation went from 5% to 37%. That was a 32% relative increase in home price growth, and that's a very accelerated level of appreciation. If we go around the country, we can see some other areas like this would be Boise, Idaho, where home price growth went from about 12% to 40% year over year. Another area would be Phoenix, Arizona, and Arizona more broadly is seeing a lot of accelerated appreciation, as well as Southern California, and a lot of basically the west coast of the U.S. is seeing big acceleration in home prices, where not only is there appreciation, but the appreciation is going up a lot from what it used to be. The other area of the country where this is happening is the Northeast. If we go here, we can see there's parts of Connecticut, which like Stamford, which had no appreciation in 2019, 2020, but then have had 20% appreciation over the last year. Upstate New York, places like Kingston and Hudson, going to Massachusetts, Worcester, Boston, all the way up to Maine, are seeing a similar thing. Now, in between the flyover country, we can see that the acceleration of appreciation, the areas in blue, is much lower. For instance, if we were to go to a place like Ponca City, Oklahoma, actually appreciation there over the last year has been lower than it was the previous year. And if we go all around here through Arkansas and Missouri, up to Illinois, all the way to Indiana and Ohio and Michigan, a lot of these areas of the country have had much more moderate levels of appreciation growth. Now, the question to ask yourself, which I think is probably the one that you guys are already asking, is what type of city or metro is better to buy in 2021 in a bubble? Would you rather buy in the market that's experiencing accelerating appreciation, all those metros in red, or would you rather buy in the market that's seeing more stable appreciation, which was those metros in blue? Now, there's only been one other time in U.S. history where we've actually seen large cities, large markets go from 5% appreciation to 30% appreciation. It only happened once before. When did it happen? 2005, 2006. That was the only other time in U.S. history where we saw so many markets, so many large cities have such big sudden gains in home prices. And that was, of course, the peak of the last housing bubble. That's right, 2005, 2006. That was the previous time and the only other time in U.S. history where we've seen home prices go up so much. Now, if we go back to that last housing crash, we can learn some very interesting things by evaluating the cities that had the biggest increase in prices. So what you're looking at on this graph are two axes here. One is home price growth in 2005 and 2006, how much home prices went up over those 2 years at the peak of the bubble. And then on the y-axis, we're looking at the subsequent decline in home prices from 2007 to 2012. And what you can see is, abundantly clear is that there's a strong relationship between these two variables. The more that prices went up in a certain city in 05-06, really that accelerating appreciation in 05-06, the more that they then went down over the next 5 years. So let's just take a look. A market like Las Vegas saw 58% price growth in 05-06 and then saw a 63% decline in prices over the next 5 years. So the price growth just got completely wiped out in a place like Las Vegas. A place like Cape Coral, Fort Myers, Florida, very similar situation, 57% price growth, 56% decline in prices going forward. We look around, we can see markets like Deltona, Florida, Tampa, Florida, Lakeland, Florida, Phoenix, Arizona, Bakersfield, California. It was a lot of like the Sun Belt growth markets that had big surges in appreciation and then big subsequent crashes in price. If you guys are enjoying the data in this video and you want to see more of this content going forward, just make sure to hit that like button. When you do that, when you hit the like button, it gets me a bit more exposure on YouTube. And when I get more exposure, I can actually spend more time producing these videos and create more of them going forward. Additionally, make sure to leave a comment. I want to hear about your perspective on the housing market. What are you seeing as a buyer, seller, renter? When you guys comment, it makes these videos better. Now, if we go to the top left of this graph, it tells a very different story. These are markets like McAllen, Texas, Buffalo, New York, Pittsburgh, Pennsylvania, Syracuse, New York, Wichita, Kansas, which had very little price appreciation during the bubble, and then as a result, basically had no decline in prices once the crash hit. Like McAllen actually grew home prices by 7% during the last housing crash. Pittsburgh grew home prices by 4%, Buffalo by 2%. Wichita basically was flat. And so the last housing crash did not affect all areas of the country equally. And so it's really important that you understand that, guys. In the last housing crash, certain cities weren't affected at all, and then other cities were severely affected. And the main differentiating factor between them was how much prices accelerated before the bubble burst. And looking at that now, we got to bring the attention to 2021. Markets like Austin and Boise and places in Arizona and Southern California and the Northeast that are experiencing accelerating appreciation right now, well, history and historical data says that you should be very concerned buying into those markets in 2021. Because when all of a sudden the housing market goes from being plus 5% appreciation to plus 30% in a year, historically it's only happened once before, and when it did happen, huge price declines followed. So that first data point that you need to be tracking, appreciation acceleration, avoid the markets or be cautious in the markets where we're seeing home prices go up really, really fast all of a sudden, and be more aggressive and target the markets where we're seeing more stability in appreciation, because those stable appreciation markets are much more likely to hold their value during the subsequent housing crash. Now, I just want to address something real quick, and that's the fact that the data I just showed you, right, and the conclusions from it, that the slower, more boring growth markets are the ones to target, such as the McAllen or Buffalo in a bubble, and that the high growth markets like the Phoenix or Tampa should be avoided. That's very contrary to what conventional wisdom suggests. And the popular narrative goes, oh no, you want to be in those high growth markets because they have higher appreciation and higher migration. But in fact, the historical data says just the opposite. You want to avoid those markets at the peak of a bubble because they have by far the most downside as the bubble bursts. Now, it's at this point that we should segue to the second data point that we need to cover and that you need to track so you can figure out whether your city is facing a housing bubble and bust or whether it's secure. And that data point is sales velocity. Sales velocity. Quite simply, how much properties are being bought and sold in a given market? Is a given home getting bought and sold once every 1 or 2 years, or is it being sold once every 10 years? That has a big impact on how stable your market is. The more that homes are being bought and sold, the higher the velocity, the more artificial and speculative that housing market is. The more that homes aren't listed and aren't sold and are basically just lived in, the more secure and stable the market is. And let me tell you, there's vast differences across the country in this sales velocity metric, and this is a number that you guys need to be looking out for. And so on this graph, we're looking at sales velocity percentage, which takes the number of homes sold in the market over the last 12 months from July 2020 to June 2021, and it divides it by the total amount of homeowners that live in that market. And so for instance, Cape Coral, Fort Myers, Florida, 37,000 homes sold in the last 12 months on a total homeowner count of 216,000. That's a sales velocity figure of 17%, meaning that almost 1 out of every 5 homes in Cape Coral are sold in the last year. And that is a crazy, crazy statistic to think about, 1 out of 5 homes being sold. We can see that there's a clear trend about the cities that are at the top of this list when we see Northport, Florida, Charleston, South Carolina, Deltona, Florida, Nashville, Tennessee, Jacksonville, Las Vegas, Lakeland, Florida, Orlando, Florida, Phoenix, Miami, Tampa, Atlanta. Markets in the Sun Belt, in the Southeast, and the Southwest have much higher sales velocity. A given home is going to be bought and sold much more in these markets in the Southwest and Southeast than they are in other parts of the country. Now, if we scroll down this list, we can see that the average market, the median market, has a sales velocity percentage of 7.2%, and that's what it is roughly in places like Dallas and Louisville and Kansas City and Houston, is around 7.2% of homes in a given year are sold. Now, if we go all the way to the other end of this list, all the way to the bottom, we can see a completely different situation. In a place like Wichita, Kansas, according to this data, only 2% of homes are sold in a given year in the last 12 months. In McAllen, Texas, it's only 2.3%. Albany, New York, 3%. Toledo, Ohio, Buffalo, New York, Jackson, Mississippi, Syracuse, New York. These are markets with much lower sales velocity, aka homes are bought and sold at a much less frequent basis in these markets. Now, I don't know if you guys recognize some of the names on this list, but you should, because Wichita and McAllen and Buffalo, and we have Pittsburgh up here, these low sales velocity markets were also, not so coincidentally, the ones that dodged the last housing crash. And why was that? Because the lower the sales velocity is in the market, the more stable and fundamentally secure that market is. So if only 2 to 3% or 4% of the homes are being bought and sold in a given year, it's just much harder for some type of speculative bubble fervor to take over and destabilize the market. The other way I want you to think about this is like in a place like Buffalo or Albany, where only 3 to 4% of homes are sold. What that means is that the other 96% of homes are being lived in, right, by families and couples and households that are living in their home and plan on staying in their home. So if you have a large segment of the population that's living and staying in the home, your housing market is much more fundamentally sound and there's much less downside. Now, on the other end of the spectrum, you have that 17% figure in Cape Coral, or the 10, 11, 12% number in places like Jacksonville and Tampa. What that means is a significant segment of the sales in that market are from either people just moving in and moving out who aren't really like tied to the area long term. It could also mean a lot of investor and speculative demand. Home flippers, people coming in, buying a home, turning around, selling it in 6 months, trying to make a profit. Those are the type of behaviors that stimulate appreciation in the short run, but ultimately make a market more destabilized in the long run and create more downside potential. Again, it's not an accident that Cape Coral and Tampa were places that had big price declines in the last housing crash. Now, we can combine these two data points into one and look at both sales velocity and appreciation acceleration to get a sense of the markets that you truly should avoid right now in 2021, as well as the markets that you should target in 2021. And really, it's these markets in the top right in orange that you should be skeptical of. You should be very cautious buying in these markets in orange. The Austin of the world, which has 8.2% sales velocity, 32% appreciation acceleration. And that's causing you to think that the typical price of $480,000 is speculatively driven and is not fundamentally supported. So if you buy at that price today, you're going to have downside risk. Same thing goes for a place like Phoenix, Arizona. 10% sales velocity in the last 12 months with 17% appreciation means that that $380,000 typical price could be somewhat artificial and speculatively driven. Same thing goes in Las Vegas, Colorado Springs, Tampa, Tucson, Northport, Florida, Cape Coral, Florida. Conversely, if we go to the bottom left of this graph, low sales velocity, low appreciation acceleration, these are the markets that you should probably target in 2021, especially if your goal here is capital preservation, cash flow, inflation hedge. If you're buying real estate, you just don't want to lose money on it. These markets in blue would be the ones to do that in. Places like McAllen, 2.3% sales velocity, 5.3% appreciation acceleration, much more modest, means that typical price of $138,000 is more fundamentally driven. Wichita, Kansas, sales velocity of 2.1%, appreciation acceleration of 6.6% means that $165,000 typical price is fundamentally driven. Markets like Toledo, Ohio, New Orleans, Madison, Wisconsin, Syracuse, New York, Columbus, Ohio, and Jackson, Mississippi all are cut from a similar cloth where there's more fundamentals in the market because of lower sales velocity, lower appreciation acceleration. And so one caveat I want to give here is that those orange markets might still be good investments for some people who have a long-term investment horizon, right? Where if you are a 10-year hold on your house or your investment property and you don't have any plans to sell it in the short term and you feel confident financially you can support that property in the short to intermediate term, you could still buy in those orange markets and do okay, because the idea would be, hey, even if prices in Austin go down by 30%, which I think they will over the next 2 years, I might not care because in the long run, I know they'll bounce back and I can hold it. So that's one idea of where those orange markets could still be decent investments for people who have a truly long-term strategy and who have the finances to support a property in the short run if there's problems. However, if you're someone who's a more FOMO-driven buyer, more short-term, if you're using all of your savings for a down payment, these orange markets are very risky because there's a high probability that there's going to be turbulence and that you might be forced to have to sell at an inopportune time when prices are down. So it's important to understand that. Long-term, investment horizon versus short-term investment horizon. How much capital do I have also to support the investment if it runs into issues? Now, there's one more data point, the third data point that we need to look at here that I think is an important indicating factor of whether your market is going to experience real estate crash going forward or still secure, and that's the local economy, specifically job growth. Is your market, recovering jobs, adding jobs since the pandemic, or is it still in a deep hole economically speaking? This is going to have a big impact on housing markets, especially over the next 6 months as the eviction and foreclosure moratoriums roll off, as extended unemployment assistance goes away. All of a sudden, a lot of the job losses that have been hidden from certain cities, certain parts of the country, they're going to start to be very exposed in the real estate market because the federal regulation and support is going away. So let's take a look at the cities and the metros with the most versus the least job losses. And so that's what we're looking at on this map, where the metros in green have either job gains or minimal job losses since the pandemic, whereas the metros in red have lots of job losses since the pandemic started. And so let's just get started with a couple examples so you can understand what we're looking at here. For instance, the New York metro area has lost nearly 10% of its jobs. Basically, 10% of the jobs that were there in February 2020 are no longer here in June 2021. So a 10% decline in jobs, that is massive. That is a massive decline. And we can see that all the areas here in the Northeast are in red and are kind of really affected deeply, especially in Massachusetts, places like Springfield, Worcester, and Boston. We go up to upstate New York, there's issues. If we kind of spread more towards the Midwest in places like Cleveland and Detroit, there's really high job losses. So I want you to think about Northeast and kind of the upper Midwest area. Lots of job losses that have likely been hidden from local real estate markets due to federal regulation and intervention. That federal regulation and intervention is going away. So these job losses in the Northeast and upper Midwest are going to start impacting the housing market. The other area where this is really happening is coastal California. I mean, you could just see a sea of red up from San Diego, Los Angeles, all the way to Salinas, Santa Cruz, San Francisco. We're seeing 9, 10, 11% job losses all across California. You also go up to the Pacific Northwest in places like Oregon and up through Washington, you see a similar situation. And so I think there's also going to be a similar fate here in the coastal area. The Pacific coast is going to start to see pain in the local real estate market as these job losses start to convert into actual evictions, actual foreclosures, and actual real issues in the housing market. Now, there's also a couple other metros I want to point out here. One is Las Vegas. Las Vegas has seen a 10% job decline year over year, which is really big. Orlando has also seen a 10% job decline. You can see most of Florida's in green, but Orlando is in one spot in red. Additionally, a place like New Orleans has seen an 11.5% job decline. So these heavy tourism, leisure, and hospitality places like Vegas, New Orleans, and Orlando, I see a lot of pain in those markets coming forward because they have a lot of very exposed renters and owners to the economic problems that currently exist. So to summarize, I'm avoiding markets right now that have high appreciation acceleration, that have high sales velocity, and that have high job losses. That combination, or a market hitting two of those three, is one that I'm not liking here in 2021, one that I think has a high chance of big price declines going forward. If a market doesn't meet any of those criteria or only meets one, it's more secure of an investment, less likely to experience price declines going forward. So in the event that I didn't hit upon the city or market that you live in and you want to learn more about it, why don't you leave a comment? Give the video a like and then leave a comment and let me know what metro area you live in, and I'll try to respond with some data from what we covered today so you can have a better sense of the risk factors of the market you live in. I'm not going to probably be able to respond to every single one, but I'll try to get to as many as I can. All right, everyone, I hope you enjoyed this video. I love putting this content out. I come out with 2 to 3 videos per week, real estate data driven. If you're enjoying this content and you want to see it more often, hit that subscribe button. Amazingly, only 15% of my viewers are subscribed, which is kind of hard for me to fathom. So I just want to get that 15% subscription number up to 20-25%, as high as it can go. So I really appreciate your subscription, especially if you enjoy this content and want to see more of it going forward. All right, everyone, until next time, this is Nick from Venture Consulting signing off.